macroeconomic news flow in the weeks leading up to and coming out of Christmas is going to be quiet, and the scheduled corporate news flow thinner still. So this seems a good time to sit still and take stock. The combination of Liberation Day's tariffs, wars in the Middle East and Eastern Europe, galloping government debts and active debate about stock market bubbles, well, it doesn't really feel like a particularly favourable mix for investors. But for all of that, many will look back upon 2025 with contentment, as it's been a pretty good year. Equities, bonds and commodities all provided positive returns to varying degrees. Hopes for interest rate cuts, cooling inflation and steady, if unspectacular, economic growth also give grounds for optimism in 2026. However, late-year ructions in the cryptocurrency arena and the ongoing surges in gold and silver may yet be harbingers of heightened volatility in the year ahead. Moreover, from the perspective of stock markets, 2025 was unusual in that America isn't leading the way. Among the major indices, Brazil and Hong Kong did best, at least in local currency terms, to perhaps suggest emerging markets are, well, emerging from a long period of underperformance. It's therefore worth thinking about what happened in 2025 and why, and whether 5 trends in particular can continue in 2026 and beyond. The first theme is that tariff and trade worries largely faded away. President Trump's Liberation Day announcement on the 2nd of April did cause panic, but it didn't do so for very long. Global equity markets motored higher as President Trump delayed the imposition of tariffs until August in many cases, and then struck individual deals with certain countries. As a result, rightly or wrongly, equity investors seemed comfortable with the view that the hit to growth, global trade flows and corporate margins from tariffs will be pretty modest at best, although it still remains to be seen whether companies start to pass on any latent price increases in the coming year. The assertions of both President Trump and US Treasury Secretary Scott Bessent that exporters, not importers and American consumers, will pay are still open to debate, and moves to reduce tariffs on foods where American domestic production is not sufficient may yet prove to be, well, a bit of a giveaway. The second theme, well, is that emerging markets roared back, and again that's after the thick end of 2 decades out in the cold. The best individual performing stock markets to date in 2025 as I sit here, well, they're South Korea, Greece, South Africa, Poland and Chile. That would be a nap hand for emerging markets had Greece not recaptured developed market status back in September. Having come through their own debt crises and indeed currency crises in the late 1990s, many emerging markets now have lower debt to GDP ratios than their developed Western counterparts. They also, in many cases, acted more quickly to quell inflation at the turn of this decade and thus have more scope for monetary stimulus in the form of interest rate cuts coming up in the year ahead. Any prolonged dollar weakness would be a further bonus for emerging markets, as a soft greenback would lessen the burden of dollar-denominated debt held by emerging market nations. And commodity price strength would help some emerging markets too, as was, for example, the case in Brazil in 2025. The third trend, well, that's the return to favour for the fixed income asset class. After a fallow 2024, bonds did well in 2025 as investors reacted to interest rate cuts from central banks. That monetary easing, coupled with the view that the peak in inflation was well and truly behind us, prompted investors to again reach for the yield on offer from bonds. The absence of any global growth shocks, barring maybe 1 week in April at least, also raised the attractiveness of investment grade and high yield corporate bonds. Further rate cuts, on top of the 130 or so seen in 2025, could help in 2026. But any unexpected stickiness in inflation would be potentially a challenge across sovereign, investment grade and high yield corporate debt. And any growth shock could leave high yield spreads looking thinner than ideal. Remember, that's the premium you get on a high yield corporate bond relative to the yield on a government bond. Bond vigilantes also continue to watch absolute levels of government borrowing in the developed West with growing concern, and this could yet remain an issue for sovereign bonds. The fourth notable trend from 2025 was weakness in oil prices. Even war in the Middle East and Eastern Europe, sanctions against major producers, and the absence of any economic shocks could not help the oil price catch a bid. Brent crude peaked at just north of $80 in January, and then it was pretty much downhill all the way from there as oil ground lower for the rest of the year, hampered by OPEC plus production increases, President Trump's well-stated preference for a weak oil price as part of his plan to let the American economy run hot, and the ongoing drive towards the net zero targets for 2050 laid down by 2016's Paris Agreement. Weaker oil did, however, help inflation to cool, so in that respect it was helpful, but it also left investors to once more address the question of whether hydrocarbon assets would be left as stranded assets with a lower valuation than that currently attributed to them. As a result, the stock market capitalization of the S&P Global 1200 Energy Sector Index is just 3.3% of that of the overall S&P Global 1200 benchmark, and that's well below the long-term average of 7.7%. In effect, oil stocks have almost effectively been written off, even though the globe continues to rely heavily on hydrocarbons today as it seeks to manage the transition to a more renewable world. And the fifth and final standout trend of 2025, well, that was how both gold and silver shone so brightly. Gold and silver are both into their third major bull markets since President Richard M. Nixon smashed up the Bretton Woods system and withdrew America from the gold standard back in the summer of 1971. Some investors, well, they may seek out precious metals as protection from inflation, a strategy that frankly worked extremely well in the 1970s. Others may warm to precious metals in fear of currency debasement, should central banks and governments rely on financial repression in the form of zero interest rate policies, or ZIRP, and quantitative easing, or QE, as a way out of their current debt tangle in which they still find themselves. Other investors, they may be just looking for a haven during a time of geopolitical uncertainty. Either way, interest in silver and gold could lessen, therefore, if equity markets' preferred scenario of cooler inflation, steady economic growth, and lower interest rates pans out as expected, and central banks therefore prove that they're on top of the situation. Equally, any diversion from that fairly narrow path, and any sense that central banks are not fully in control, could yet give precious metals a further boost in the year ahead. I hope that you and your families are all keeping well. Thank you for watching, and I look forward to seeing you next time when we shall look at the key market and macroeconomic trends and what they may be in 2026, and how they in turn could shape the performance of your portfolios.